Hi traders, this is Ron Hayde at Market Tamer. Happy Monday. Hope you're doing great. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. TradeStation is back on your screen. I'm using the color scheme that you guys preferred previously, so hopefully everybody likes it. All right, first off, I had a question about moving averages. Let's just start there. So the blue line is an 8-day EMA, 20-day EMA is the red line. The orange is the 50S or simple moving average, and the purple is the 200 simple moving average. Orange, purple, institutional, very long-term in nature, and the blue and the red are the short terms. So difference, EMA, SMA. SMA, which is orange and purple, each day gets the same weighting in the formula. So whatever happened day 30, 47, and 50 ago gets the same weighting as today. Same for the purple line. In the exponentials, it's much different. The most current day, which is today, gets the heaviest weighting in the 8-day formula and the 20-day formula. And then what happened 20 days ago in the red line gets the least weighting, and the same thing for the blue line. What happened 8 days ago gets the least weighting, whereas today gets the heaviest. You get the idea. For shorter term trading, I think exponentials work better because what truly did happen today could be more important than what happened 8 days ago, right? Upgrades, downgrades, etc. However, when you start talking about 50 and 200 days worth of data, I mean, there's so many data points. Really, what happened day 50 ago to day 30 and day 20 really isn't all that different because there's so many data points to add up. Now, if you said to me, but I really like EMAs, is that a problem for a 50 and a 200 day? No, not really. The lines will be slightly different because they are most heavily weighted to today's action. But I've found, based on my own research, that the SMAs on the long-term moving averages, the 50, even the 100 or the 200, they're more common. That's all. Tomato, tomato, there's no right, there's no wrong. You can use whatever you want, in my opinion. Okie doke. Markets, spiders, SPY. Again, black candle up day, red candle down day, volume, black up day, red down day. If it's gray, it means it was flat on the day. Closed a little higher today. Yes, that is a reversal type candle, but we just can't go with one day. And you want confirmation. You want 2 or 3 days for reversal or bearish engulfing or something like that. That's not the case. Here we actually had bearish engulfing. Then we had a 1-day pop, then the drop. So this is still an uptrend. With using Thinkorswim, we have 5 straight up days here in the SPY. If I move, not DOA, dead on arrival, that's funny. How about DIA, which is not dead on arrival? We have 6 straight up days. Again, dark black candle, meaning we gapped up, closed lower, but still higher than the previous day. So in essence, we finished lower than where we opened, but still higher than yesterday or Friday. Target is still the all-time highs. Now on the diamond and the SPY, let me stop there. I had another question saying, well, what's going to be the catalyst to get us higher? Does it really matter? If we're looking for one, sometimes you end up missing it. I'm of the opinion, trade what you see, not what you think, because you can listen to all the talking heads out there and everybody has an opinion. I have an opinion. I think we're going way higher. It's going to blow people's minds. And I've been saying that for the last couple of years, but doesn't mean it's going to happen. I can be bullish and bearish in the interim. Right now, we had a chance for the market to fall off, and it didn't. They keep tying it to the trade wars. But remember, that is what they were doing to everybody over here in October and November, and they tanked it into December. Then we have the V rally. None of the news really changed. Maybe the headlines did. Maybe they were trying to, instill fear in people or whatever. And here they go do it again, and they dip the market, and yet it comes right back up. So when we break moving averages, we break swing lows or something, we can be bearish if we want to, right? It's something we can consider. I can't tell you what to do. I'm not a licensed financial advisor. Don't ever want to be one. And when we're above moving averages, I can be bullish. And that's how I like to teach. It's how I like to view the markets. I think it's a much simpler lens than trying to find the exact reason why something may go up or may go down. Now, maybe if you're someone like a Buffett or somebody who has a very long time frame for holding positions, Berkshire has a ton of Apple. Short-term gyrations don't matter. So to each their own. I prefer what we call swing trading, not looking to day trade and just catching the ebbs and flows of the market. And that's what I like to do in these videos. So the bulls have the edge on the spiders and the diamonds because we're above major moving averages. Now, if I go to the Qs, they are lagging in part because the DOJ and FTC inquiries or inquisitions We tried to get above the 50-day today. We could not. We still closed below it. Caution is still warranted here on the Qs. And I have to say, caution warranted on Google, Apple, Facebook, Amazon for the foreseeable future until this is all over with. Whether you like it, you don't, doesn't matter. There's just a lot of uncertainty out there. If I look at the IWM, which is the Russell 2000, IWM, not WM, was only up 0.59% today, way off its highs, and it's still below the 50-day in orange and the 200-day in purple. This one is lagging badly, and that's usually a bad sign for the market, just like I commented in the weekend video. So Nasdaq and IWM still lagging, but overall, bulls get the edge because of the spiders and the Dow. Had a question on Roku, and how does it look technically? If I look at all the data according to TradeStation, we're up at near all-time highs. The blue line is the 8-day EMA, and as long as it stays above there, in my opinion, that gives the bulls the edge. I mean, right here on the 3rd, it did get below it just a teeny bit, but then right back above. If it gets below the red line, I think that's my litmus test. That's the canary in the coal mine to say the sentiment is changing. You're now losing 20 days worth of data, which is really 4 weeks in the market, 20 trading days, then the target's down here. So how I view it, as long as it's above the red line, bulls get the edge. TLRY was in the news. They had a nice pop today, 12%, 7.3 million shares. The average is about 1.6, so that's a whopper of a move. It is a high wave doji type situation, but we did finish up and we're above the red line. The red line now, the 20-day EMA, which is something we haven't closed below since February, closed above since February. That would be my trailing stop if I wanted to consider trading this one bullish. And then here is CRON, something different. I found this one in the big movers list, stuck up 9+%. Nice pickup in volume, but also a couple days ago too, we had a nice pop in volume. This stock was, mid to upper or low to mid 20s, gets down to 14, hits the 200-day. Interestingly enough, if I zoom out, it also got below the 200-day back in October when the market began to sell off, but only for a couple days, not very long. And then once we got above it, back test, back test, back test. Whether it's just pure dumb luck or that institutional moving average is actually being respected, that seems to be a line where they buy even into the dips because that goes right back up and they rip it above it. So maybe the 200-day EMA could be a potential trailing stop. It is a little far away from the stock, right? If it gets below there, that's bad news because the next swing low becomes the target, which is substantially lower. But in the short term, I could even consider a red line as a potential trailing stop, the 20-day EMA. With today's big strong move above the 50-day, guess what? Next target, 22-24 range, right back up there. So that's it. Nice short video. Hopefully this answers some questions on EMAs versus SMAs. If you have any other questions, you want something covered, you know where to find me. You can drop me an email or make a post to the YouTube channel. Have yourself a wonderful day, and I'll see you in the next video. Take care.